we are live on Facebook for the Not Your Average Investor Show.
Don't pull something.
Live on Facebook for your Not Your Average Investor Show, Thursday edition. I'm your host, Pablo Gonzalez. With me, as always, my co-host, the man that they call GC because he has a gargantuan capacity for giving. His name is Gregg Cohen. Welcome, Gregg.
All right, how's this, Pablo? I'm ready to be here on the Not Your Average Investor Show. This is incredible. Thank you all for being here.
As our regulars know, I have a little bit of housekeeping, but just to get everybody in on the inside joke here, Gregg and I have been joking around about how much I can exaggerate the pre-intro, kind of lean in and say that we're part of the Not Your Average Investor Show, and this is the first time that we're actually playing into it. So just hang in there.
This is going to be like the Geico commercial where the guy's in the gym and then he says like, "How much did you save on insurance or whatnot?" And he goes from like a little skinny guy to like Hulk Hogan. I feel like this is just going to continue every single show. It's going to be 18 rotations of your head next time.
I hope you're right. At some point, I'm going to stop rotating my head, jump up, do a spin, a split, and get up and say something, right? Like, I think that's the logical progression. But anyways, anybody that hasn't been here before, this show is about you, right? This Thursday show specifically, right? This property breakdown that we do, it is to inform you on anything that you want to know about rental property investing. And it is fully interactive. You drive this show. The two ways to interact with us is, number one, click open that chat button. And I see a lot of people already contributing into the chat, but there is something that I need you all to do. And that is, when you see the chat box right above it, there's a blue drop-down menu that says panelists. If you click on that and put panelists and attendees, now everybody can see what you are contributing. So team Jeff and Carol, married 29 years. You only said that to us panelists, but congratulations, Jeff and Carol. Who else here has done it? Eric Haynes, who's been married 26 years. You were only talking to the panelists. If you could hit that drop down and put in panelists and attendees so everybody can see what you are contributing, you're able to, again, give your value when we're contextualizing things, maybe network within this group. This is all a big community that we have here with the people that come back and hang out with us every week. And those of you that are joining us for the first time, we want you back too. So we want you to feel a part of it. And then second is, if you want a question, if you want me to ask the man with the gargantuan capacity for giving, Gregg Cohen, you want to pop open that Q&A box and drop the question in the Q&A, because as you'll notice, the chat box moves at a rapid rate, and I can't really keep up with all of it while trying to keep up with what Gregg is saying, because he's going to quiz me from time to time. So the best way to keep me organized and, help me help myself and help you is to use that Q&A box for whatever questions you have. And last but not least, if this is your first time and you want to download this investing template that JWB has created to foresee whatever. Yes, Lee, I did. I moved the golf clubs again. I'm trying to see if you noticed. If you want this template that we are going to be fiddling around with here, looking at this property to analyze any future real estate deal that you have, plus get to spend 45 quality minutes with Gregg, telling you all the benefits of rental property investing, how to go about it, what the best markets are, and the things that you really need to know about it, go to jwbwebclass.com, sign up for that webinar, download the free investor packet. It's going to be awesome. And if you love this property or you love what we're saying and you want to move on to the next step, the move is to go to chatwithjwb.com. That's a calendar link that you just pop in with the Mikes and Courtney, and you'll get to hop on a call and get personalized recommendations of where you are in life and what you need to be doing. But without further ado, the star of the show today is the property in the JWB Rental Property of the Week. Week. So Gregg, we are going to 3141 Mel Court. While I am popping this thing on the screen, you wanna give me a little background on this thing?
I do. This property is really exciting for a number of reasons. But this property is going to be like the gift that keeps on giving, right? We're going to talk about just the nuts and bolts of this property first, and why it attracted me to bring it to you as a property of the week. So we're going to talk about that first. There's a couple of other things, little teasers here about this property that are pretty incredible and not normal when it comes to rental property investing. So we're going to talk about the normal, just the baseline, why this thing is awesome. And then we're going to talk about some other things that can happen that can be really to your advantage as a rental property investor, specifically with JWB. So where should we start, my friend?
Well, in this episode of Tales of the Abnormal Property, for those of you that don't know, we repurpose this into podcasts, right? We try to make this as easy to consume as possible. So we're going to explain a little bit what's going on the screen for our friend that's listening on the podcast in the future. Welcome. Let us know how it is in the future right now. But so we're looking at this. There's a picture here. This is a $140,000 house, 3-bedroom, 1-bathroom, driveway, an estimated rent range of $1,025 to $1,100. It's been the lease seems to be at $1,025 right now. And the estimated conventional financing total ROI is 10.98%, close to 11% there. And the monthly cash flow is $231. So let's start with basics here, Greg. What does that estimated conventional financing total ROI include? What does it not include? Let's catch everybody up.
Yeah, absolutely. So to put this in context, the return on investment is where you want to go first when you're making your decision on if this is a good rental property for you, right? The reason why that matters is because the return on investment takes into account all of the good things and all of the bad things for a rental property. And it's a good equalizer, right? The good things for a rental property are rental income, right? It also takes into account your tax savings, right? It also takes into account your principal pay down on your property. These are other profit centers. So it takes all these good things. And it also takes away the expenses, right? Pablo, I'm going to quiz you because I haven't quizzed you enough, right? I used to quiz you a lot more. I haven't done it in a while. Can you name me some of these expenses that come out of a rental property?
Yes. I would say fixing a toilet, any kind of like maintenance costs, right? That's like a screen repair, something that may happen. What else? Landscape. I don't know. What outside of maintenance costs, what else is there? I really don't know.
Who do you pay to collect your rent?
Who do I pay? Oh, property management fee.
Property management fees. What does the county charge in order to do a lot of the services that they
water
want?
And sewer and stuff like that, right? Like
yeah, well,
taxes,
they're going to charge
property taxes and fees.
There you go. And then our friends at the Ritchie Insurance Group, what do they provide?
Insurance.
There we go. Right.
It was either Ritchie or insurance. I knew I had to get one of those. Right?
Property taxes, insurance costs, your mortgage payments to your bank, right? You got to factor that in, your property management fees, maintenance costs, vacancy costs, all of those things are included. So you take all the good things, which is your net rental income, you take the profit centers of tax savings and principal pay down, and you take all the expenses that are associated with it, you subtract all of those as well, get rid of all of those, and the net return on investment is what you're left with over what your initial investment is. And that's your return on your investment. It's the net return over your initial investment, and your initial investment would be your down payment plus your closing costs. But there's one profit center that we didn't talk about, Pablo. What profit center is not included in that roughly 11% return on investment?
Well, I would guess that it is right here, this 0% appreciation rate that you got going on.
Absolutely.
Tell me why.
Well, we and our friends who watch the show often, I want you to hear this over and over and over again, because many people don't properly factor in home price appreciation into their evaluation. But this is not going to be new for many of you, right? We do not factor in home price appreciation, even though Jacksonville is a market that historically has grown more than the national average. Even though compared to other cash flow markets, Jacksonville on average has appreciated 34% more since 1991 than comparable cash flow markets. We still don't put it there. Part of that is because we want to under promise and over deliver in what we do, right? And I don't know how long you're going to hold on to your property. And really the only way that you can count on home price appreciation is if you are a buy and hold investor, right? You shouldn't be counting on home price appreciation if you're in this for 1, 2 years, 3 years, right? Appreciation is highly speculative in the short run. 3 years, 4 years, right? 5 years, right? It's highly speculative. But over a full market cycle, it repeats itself. So what that means is if you go back and you look at what your market has historically appreciated at over a full market cycle, we go all the way back to 1991 because that's when the data becomes very accurate through the Federal Housing Finance Agency website. You go back and you look there, and whatever that home price appreciation rate has been, most likely will be close to what your appreciation rate will be over the next market cycle. And how long is a market cycle generally, Pablo?
10 to 20 years.
10 to 20 years. So what that means is if you're a buy and hold investor, you can count on home price appreciation if you're in for a full market cycle, and then you should count it into your overall return on investment. And Pablo, looks like you're teed up to hit a very important keystroke right here.
I am teed up. So for those following at home, 4.3% is the historical home appreciation rate for Jacksonville. Right now, this is showing a 10.98% ROI. I'm going to hit enter here and it's going to calculate through. And the ROI jumps up to a whopping 26.62%. Greg, you want to explain that for our noobs?
That's financing at its best right there. So this is talking about your return on investment when you include home price appreciation. Home prices on average each year go up about 4%. But if you're only putting 25% down on the property, that equals about 16% of a real return on investment if you're factoring in the returns from home price appreciation. So just real simple math there. You add 16% to, basically 10% or 11% of what it was. And that's how you get to that 26% return. And really that's year one returns. If we were to build this out year over year, right, appreciation compounds on itself every single year. And so the returns and the benefits of holding on over a full market cycle are actually higher than what we're showing here, but we're showing here year one for simplicity's sake, because I want you to see all profit centers. And if there's one thing that most investors in rental properties do not fully grasp, it's all 5 profit centers, not just net cash flow.
Got it. So you've explained that a couple of times. I don't think you've ever mentioned the whole like compounding year over year thing. So how do I conceptualize the idea that this compounds year over year? Like, is there an easy way to explain that?
There is. We could probably do it if you go to the analysis of conventional financing tab.
Sure. Where do you want me to go here?
You know what? I might get you guys lost in the numbers here if I do that, to be quite honest. Let's go back to the summary. Let me just kind of talk through it.
All right, cool. Yeah.
So basically, when your home prices each year go up, they're going up 4.3% on average over the previous year, right? So let's just say that the house value for today is $100,000, right? If it goes up, let's just say 4% over the next year. What's that return? What's that house then worth, Pablo?
I was looking at where I was going to go next, Greg.
Gotcha.
You got me.
Gotcha. All right. You've got a $100,000 house and it goes up and it appreciates 4% a year. It's worth $104,000.
Okay.
Right. So you earned $4,000 of gain on that. Now the next year, it's let's just say 4% gain on $104,000. Right. Okay. I'm just going to do that quick math right here on my cell phone. 104,000 times 1.04 is $108,160. So a 4% gain on $104,000 is actually a return of $4,160.
Makes sense.
And you keep going down the line, and we used a number of $100,000 here. As you can see, the property value here is $140,000, and prices range between generally around that figure to maybe $210,000. The higher the price, the bigger the return in an appreciating market for holding on longer. So
that makes sense. Okay. So now here's something else we haven't talked about. So the higher the price, the higher the return long-term in an appreciating market. So that's the benefit of buying a higher priced house. I look at this house and I see 140,000 is on the low end of the spectrum for JWB, right? So the cash flow seems about right on average with what you normally get right here in the 230s. So you get a lower down payment. slightly less appreciation over time than a higher price thing. So that's like the give and take.
Well, you got to consider what your initial investment is, right? So your return on investment is a factor of how much you had to put down. So like in essence, if you paid $280,000 and you still put 25% down for that, your initial investment would have been twice as much. And then
Correct.
your return on the appreciation for that $280,000 house would also be twice as much. So it doesn't mean that buying higher priced homes, you're going to earn more of a return from appreciation. What I was just saying there is that a higher priced home will appreciate in like net dollars more. But if you're going into it, you have to factor in what did you put down as well. So does that make
Yeah,
sense?
yeah. The percentage stays constant, but the actual number is bigger because you're
Yes,
playing with bigger numbers.
exactly.
That makes perfect sense. Okay, cool,
Yep.
man. I feel like we just uncovered some new stuff there on the Not Your Average Investor show.
You know what?
The other thing, yep.
Big credit to Mike Foster, actually. Mike Foster is a long-term client of ours, and he reached out to me and he pointed this out. He's like, Greg, you don't really talk about the long-term effects of actually holding on and why it makes more sense. And so he put this bug in my ear, and I wanted to make sure that I explained it to folks. So thank you, Mike, for bringing that up, and always appreciate all the feedback from all of you, either on the show here or in the group that we have, or over email. You guys help make the show better. So thank you so much.
I love that you bring up the group, right? So anybody here that's new, we do have this Facebook group. It has over 1,800 real estate investors. You can find it at jwbfacebookgroup.com. We reference it a lot on the show. Gregg goes live in there. That's where the majority of our interaction between shows take place, and we'd love to have you there. We used to call it our secret cool club, but now that there's 1,800 people in there, it's just a cool club. It's no secret anymore. So Gregg, I'm looking at this house, right? So this to me looks like a renovated house, right? It doesn't look like the typical models that JWB builds. And I also realize in the models that we build, there is usually a garage, right? Like, and this house doesn't have a garage. You want to talk me through the benefits of or what I need to think about when it comes to whether my rental income property should have a garage or not?
Yeah, it's a really common question, especially for those who may be newer into rental property investing. If you're somebody who's coming into this asset class and maybe you're coming from a more traditional investing background, many people think, well, I probably need to have a garage in order for this to be a successful investment, right? Or they might think, I need this to have 2 bathrooms for this to be a successful investment. And a lot of times what that is that person is taking themselves and putting themselves in the shoes of their resident. And they're saying, in order for this to make sense for me, I have to be willing to rent this house, which is not the right way to go into this, right? We've got to be able to understand what our role is here as an investor and how we are going to have a successful investment. You are not your resident. You're not renting to yourself. And your job is to create value for the person, for the family that is going to be renting your home. And that's a really big key. Many folks can't separate this. And the problem is that if you try to do everything, you're going to have a less successful investment property. And truly, what doesn't matter is whether or not you would rent your home. That is the least most important thing when it comes to finding a successful rental property investment. But I don't think I answered your question, by the way.
I don't think I was like, did I miss something here?
So I got off on a tangent, right? But you've got to separate this, right? You've got to separate from whether or not you're trying to rent the home to yourself. Now, when it comes to renting a home that either has a garage or doesn't have a garage, your job is to create value. The way you look at value is this the best option for the best price for my resident to spend their rent on that's going to make them want to be here for a long time? And so you consider the alternatives for that end buyer, just like any other business would, right? That's what you're doing here. And so what you'd want to do if you're trying to decide if you should rent a property or buy a rental property, go take a look at the other housing stock around that street and in that neighborhood. And that's going to be your guide. If all of the other homes in the neighborhood are 3 bedrooms and 1 bath, maybe you have some 3 bedrooms, 2 baths, but it's very common to have 3 ones. And if you don't have a garage or you have carports and you don't have these 2-car garages out there, then by all means, 3-bedroom, 1-bath homes without a garage is going to be a great investment. I own many, many of them, right? But you got to look at what the comparable options are. And then you have to set the right rent amount, right? If you go around the neighborhood and you see all bigger homes with garages and you're the 3-1 without a garage, that could be an issue, right? You would have to take a steep rent discount to make sure that you're the best option for that resident who's going to want to stay there for a while. And if you know, and for folks who are looking at this house on Mel Street, you know, I'd encourage all of you, you can go to Google Maps and you can see Street View. You can go and look around all the other homes in that road right there. You're not going to see any that have garages, or very few that have garages. You're going to see similar floor plans, 3-1s, 3-2s. So you don't have to take a discount of rent here. It's already baked in. This is what this home, this is what that renter, that resident is going to need for that area. And then we make sure that the home is top quality shape for them.
Now you answered it, Greg. And I highlighted the property information here, right? 3141 Mel Court. I encourage anybody that's on the call right now, go into Google Maps, pop it in there, go into Street View, and you can like hit those arrows and look around the different neighborhoods. And you're going to see a lot of houses that look a lot like this, right? So again, just validating what Greg's talking about. Greg, let's get into some of these questions before we get into the abnormal tales of this property. Peter asks, Peter, welcome back. I recognize the name from last week, and he asks, may I ask what's the estimated time frame for a cash out refinance? Thank you both.
So a cash out refinance is really popular right now for two reasons. Number one, because there has been a higher than normal home price appreciation in many, many markets across the country over the last 5 to 8 years, which has established more equity in the homes for investors out there. And then the other reason is really low interest rates right now, historically low interest rates that will probably never be lower again, because they can't go lower. And so it is a really popular thing. We have many clients right now who have equity in their personal residences and their other investment properties, and they're pulling that equity out because the debt is so inexpensive. And they're using that to purchase additional rental properties to help them get to their passive income goal. So a question though is, what's a normal timeline? It can change. It's heavily dependent on what the market has done over the last, call it 5 years, and what interest rates are going to be. This has been a great time to do it. It's not always this great of a time. What I would tell you is that, in order to get a cash out refinance, generally, they're only going to lend 75% of the value of the home. And there's also going to be some costs that come along with it. Think of just an average, think about maybe $3,000 in costs that you spend when you get a refinance. Okay. What many people don't think about is that many people put 20% down when they purchase the property, which is an 80% loan. And then when they go to refinance it, the lender is only going to lend 75% of the value of the loan. And you have those other $3,000 in costs that come along with it. So sometimes it takes a little bit longer for you to build up enough equity for you to do all of this and then be able to pull out, additional equity on top for it to make sense. I'm thinking in the first 5 years, it's usually unlikely that it's going to make sense for you. Not always, right? So that some clients have been able to pull out funds over the last 5 years because it's been an appreciating market. But, usually the first 5 years, not really planning on doing it, usually closer to the 10-year mark.
Great answer, Greg. Margaret Smith has a couple of really good questions, and Margaret's another name that I'm starting to see coming around. Margaret, good to have you, and thanks for putting this over in the Q&A box like I asked. She puts, so I put in 20% equals $28K for this $140,000 house, but I also put in cost of closing / acquisition. What do I factor for that?
That's a great question. We can certainly help you out with that, Margaret. In fact, Paulo, would you mind going over to that analysis conventional financing tab?
Way ahead of you, buddy.
All right. For anybody who hasn't yet downloaded this investor toolkit, you guys have this at your fingertips. We made it editable for anybody who's using this so that you can go in and plug in your numbers for the property you're analyzing and have this thing kick out all the profit centers like we're talking about here. So Margaret, great question. If you don't have this yet, make sure you download it. And then what you'll want to do is go to this analysis conventional financing tab. If you go over to the right a little bit, Pablo, what you'll see is that the total initial investment includes both your down payment and your estimated closing costs. So for any of these investment properties that you see through JWB, that's going to be baked in for you. And if you want to click on that $3,500 tab, which is what we estimate for closing costs here, let's see, I think it's about a 2.5%. Yeah, there
Yeah,
we go.
it has it. It has it at 2.5%.
Yeah, there you go. So we do 2.5% of the purchase price is your estimated closing cost. That's an easy, simple figure that we pulled after looking at all the closings we've done over the years, literally, tens of thousands of closings that we've done on the buy side and the sell side over the year. And so that's just a good rough estimate for you.
Cool. So let's play around a little bit here. Let's put in a 20% down payment if that's what you're going to do, just to kind of show off the sheet, see everything, updates, and you see what your investment needs to be. I can also go back to the summary tab here and pop in the appreciation rate again, so that we see what it looks like on this side also, right? Everything populates through. So it's a super friendly spreadsheet. And Lee Bishop in the comments puts, Pablo, a 155,000 house in 10 years with 4.3% home appreciation returns a $91,297 profit. It's pretty sweet, man.
That's awesome. I love using this tool to do things like that. I mean, you can have I have a lot of fun with these tools. I do it every single day. So I want to share the fun with all of you. Go download this thing. It's pretty awesome. Where do we go? Web class, right? JWB web class.
JWB, yeah, jwbwebclass.com. And the fun doesn't have to stop just on the show. You can go to the web class, folks. Margaret Smith has another question. Looks from here as if the original garage was converted to another room. Is that permitted? I assume you checked that out.
Oh, yeah. Yeah. I don't know when that was done. Many times that's prior to our purchasing of the home. Certainly we did not convert this. So it was done many years ago, and I'm sure it was permanent. If it wasn't, we would analyze, we would go in, we would do our own scope of work. We would figure out what the problem was. We would fix it. We would not put a resident into a failed conversion, but there's no problems with this one.
All right. Ken asks, welcome, Ken. I think this is the first time I see your name here. Would you, at say 10 years down the road, consider demo and rebuild of this type of home?
I think that would be highly unlikely, because anytime that you go into a move like that, you want to consider what the return on investment would be, right? For you to demo and rebuild, you'd have a lot of demolition costs right off the bat. You'd be taking this perfectly great asset that's performing for you, and then you would just increase your cost tremendously. You'd have the demolition cost, right? While you're demoing this house, you don't have income coming in. So there's that opportunity cost. Then you've got the cost of building brand new construction on it as well, right? Hundreds of thousands of dollars you're now spending here. And what would your return be, right? Well, you may get a premium on what you would be able to sell the house for over a renovated home, right? New construction sells at a premium to renovations, but it's not that much, right? It's not hundreds of thousands of dollars difference, right? So the better idea here is that this is in a well-established neighborhood. This is a perfectly built cash flow positive asset. And what many people don't think or don't understand is that renovated homes built in the 40s, 50s, 60s, 70s appreciate just like new construction homes do as well. So probably not likely that you would be doing that in this home, or really in really any of the JWB homes in our neighborhoods.
Yeah, that sounds great. When I hear that question and I hear your answer, it sounds like maybe Ken was putting it through the filter of, this is a house that I live in, or this is a house that somebody I know would live in, where maybe it's, you gotta see it as these like C plus neighborhoods that are for working class families, and a new home there would kind of like stick out maybe.
Well, I wouldn't say that a new construction home would stick out, because there are many homes that are new construction in well-established neighborhoods. Many of our new construction homes are going to be the 1 or 2 or 3 new construction homes surrounded by a sea of 50 homes that were built in 1950. So that's not unusual. But in those cases, there wasn't a house that was already on there that we're knocking down. And if there was, we got that house. We bought it at such a steep discount that we basically bought it for the land value, knocked the house down, right? We're not going to take a performing house that is operating very well and knock that down just because it's just not a good return on that investment. And I like the lens that you just brought up there. Maybe that was the thought there of maybe kind of using this as an investment that's going to perform well for 10 years and then turning this into a personal residence for myself. Maybe I want to build a new construction home. It's not very likely. When clients come to us and they say, hey, I want to do this and that down the road, we ask them to make a choice, one or the other, right? Is this a personal investment for you? I'm sorry, is this your personal residence or is this an investment property? Because we can't promise both. If we try to do both, we're going to end up failing you because that's a really hard, bogey to hit right there. So we just ask clients if that's an important thing for them. They have to decide if this is going to be a great investment property and that's all this is ever going to be, then it can work. If it has to be that plus the option of making you and your spouse happy to move into later on, we're probably going to tell you, hey, this probably isn't the right thing for you. That's just not how we're built.
That makes a lot of sense, man. I got a couple questions here. I think we're going to knock out real quick, and then let's get into the abnormal properties of this property. Michael Parsons asks, do you ever offer duplexes, triplexes, or fourplexes?
So very common question about multifamily properties. And I really do love multifamily properties, but we do not offer them through JWB. And the main reason is because in the neighborhoods that we want to put you in, you're not going to find that type of housing stock, right? Out of all of Jacksonville, there's 4 neighborhoods that really work for this model. It's very difficult to find neighborhoods in a growth market like Jacksonville, where we have higher than normal appreciation, to find neighborhoods that this works in. I mean, we could go out and find a lot of other properties that look good on paper for you all, but they're going to be in low income neighborhoods. And so most of your duplexes, triplexes, and quads in Jacksonville are in those types of neighborhoods. We're not willing to sacrifice that. But we do have a solution in place. And this is something that a lot of our clients have invested in for many, many years. We build townhomes, and townhomes you get basically the same economies of scale as what you would get for multifamily properties. The reason why people like multifamily properties mainly is because you've got 2 or 3 or 4 units under one roof. So, if you've got a roof issue, you only have one roof to fix rather than 4. If you have a vacancy, you still have 3 other residents that are paying rent that are going to cover the 4th. So there's this economies of scale, and risk mitigation is what they like for it. Well, you get the same thing with townhomes, right? In a townhome, actually, you get those benefits because you might have 2 or 3 or 4 units under one roof, same thing. But you also have a lot of advantages when it comes to how you purchase and how the financing works on townhomes. So if it's something that you're interested in, I would highly encourage you to reach out to my team and start that conversation. And townhomes may be what you're looking for there.
Awesome. Great answer. And as promised, I want to answer Margaret's. Then we're going to go into some of these funny things that are happening in this property. And then we'll go back to the rest of the questions. So Margaret Smith asks, what type of insurance do you get for a tenant occupied home? What kinds of coverage do you want? Hazard, windstorm, flood, and what would be the right co-insurance or deductible, especially important for giant storms and for areas that might flood?
A lot of really detailed questions there. And insurance, I know enough to be dangerous. And then I just work with the best team out there. So to get some of those answers, I just want to put you in touch with the team that we work with. So if you reach out to my team, just go to chatwithjwb.com, set up a time to speak with us, or just send an email to info@jwbcompanies.com. That was the old info email address from like 12 years ago that I almost referenced.
JWBproperties.com, you said?
No, info@jwbcompanies.com is an email address. And then we'll just connect you with the Ritchie Insurance Group or with my team, and we'll get those answers for you.
All right, Gregg, we've been teasing it long enough. The abnormal activities that are happening in this house. What are we looking at? Huh?
I feel like we're like a week late. We've been talking. This is like Tales from the Crypt, like property, evaluation style.
I've been going for that. I've been going for that feel. Yeah. Tales from the Crypt. Yes. Yeah.
This is a really special thing that happened. So this property was actually just purchased by a client. So you guys have seen this kind of recently. You see how this kind of works. Pablo and I get together a few days before. We identify the property that we're going to bring onto the show. And all during that time, of course, our clients are talking with our team and putting properties under contract. So this one actually was just purchased by a client. And I wanted to talk through just what happened from the time that we started to market this thing Pablo and I started to talk about this thing. We put our, notes together for the show and how it's actually turned out, less than a week later. Oh, and if anybody is bummed out about the fact that this property is not available at the moment, you shouldn't be. We literally have dozens of properties just like this one. So if this makes sense to you, don't be bummed. Reach out to my team. We've got more than enough that are just like this one, and it's going to work for you. Go to chatwithjwb.com. Man, my email and my URL game is off today, brother.
It's a lot of things to keep track of in that head of yours, buddy. So let's so what's happened? So what's happened in the last week? Talk to me.
Yeah. So we put this property out there for our clients, and you can see that lease rent amount of $1025. Now, this one was not rented at that time. And this is very normal for clients who put properties under contract. You put properties under contract and they are not rented at that time. So you're putting your trust and your faith in JWB to hit that rent amount when you sign that property and put it under contract. Now, we talk a lot about how important it is to be cash flow positive at closing, and that still happens, right? That's why clients are really happy after they purchase their home. It's because once you put it under contract, you have between 30 to maybe 45 days until you actually get to the closing table. JWB is working our tails off to get that home get that home rented, have that resident in place, and that way you're not going to see vacancy costs right off the bat. It's going to be there by the time that you close, and that's how this whole thing works. But Pablo, sometimes people are a little bit, they feel like it's always a bad thing if the home is not rented when they put it under contract. But it doesn't mean that, right? Especially not with JWB. All right. So here's what happened. We put this evaluation out there at $1025 for rent. It's, the purchase price is set. The returns are what they are at a $1025 rent. Many times my team, we know we have a high degree of confidence that we're at least going to hit $1025. We may be able to get more. And the value for putting a home under contract prior to being rented is that you can be the beneficiary if we actually rent that home for more. What actually happened here, Pablo, is from the time that we started to put this home out there for our clients to purchase it, we actually marketed it and found a resident at $1,100 a month for rent. So go ahead, plug in $1,100 there for rent and see. Yeah, let's take away the 4.3%. Good call. That was the 4.3% for appreciation we took away. And we put $1,100 in there, and that skyrockets your returns to 12.75% just from the cash flows. Pablo, in all of the properties of the week where I choose really high return properties, have you ever seen anything close to 12.75%?
I've never seen anything above a 12.
There you go. There you go.
Like we've come right up close to it, but never above that. So that's really nice.
And you're not going to see one. I mean, just the way it works with the way that we have to purchase these homes and how we figure out what your returns are going to be to make sure that this works for you and factoring all the costs, it's just not going to work for 12.75% returns. We don't buy properties that way, right? Because there aren't enough of them out there at that return. So you're not going to see 12.75% returns estimated on a new property. But what you will see is, in this case, 11% is what we told you we were going to get. And if you buy it, you put it under contract, it's not rented at that time. We're still trying to get higher. And that's how you can actually really skyrocket your returns. And the client who purchased this one is really set up in a fantastic fashion for us to be able to overperform, which is what we care about.
Yeah. And, when I hear you talk about this, thanks to the fact that I've been part of your Tuesday morning meetings and all the stuff that you guys do and your adherence to core values, I hear, very loud and clear, one of your main core values that I hear the most, which is under promise, over deliver, right? So I like how you've put this of when you invest with JWB, what you're buying is the minimum that you're going to get. The chance that you're going to get more than whatever you get is there, and it's significant, right?
I think like most businesses, they try to just talk about their best selves at every point along the way, right? Because they think that they need to do that in order to attract clientele. And the minute that they are not their best selves, then it creates a poor experience for that client. We just think about it differently. My opinion is that if you can bring people on with the right expectations and then you can just do a little bit better, or maybe even a lot better, but just a little bit better, you're going to make a client for life, right? They know that they're not getting all the hot air from you, right? And so that's why weeks over weeks now, people have said, well, why don't you put 20% down instead of 25% down for your expected financing? And I said, well, that's what a lot of people do. And it jumps your returns up right off the bat, right? Or we've talked about our maintenance costs and the fact that, our maintenance costs are driven by data and might be a little bit higher than what somebody else says, which is probably not driven by data on the other side. And that lowers our expected returns. This is a part of how we think, because at the end of the day, we want you coming back and buying properties number 3, 5, 10. And you're only going to do that if you had a good experience. We did at least a little bit better than what we told you right off the bat.
Yep. That's that beautiful long-term thing. Like I hear long-term thinking in everything that you guys do, right? It's long-term hold, long-term relationships with your clients. Your property management is set up to benefit a long-term relationship as opposed to like a quick, make money on different incentives. I think it makes a lot of sense. I'm going to jump real quick to Marilyn's question that is at the bottom, but she puts, wow, is this a new investor that got this home, or was this somebody that was already an active investor with you?
I didn't look up the name of the client. I don't know. I'm not sure.
Okay. So it doesn't work like that. It's not like, hey, whatever perk we have, we give to somebody. This just happened to be somebody put this under contract and this came to be.
Absolutely. So the first step is that if you're interested, let's start that conversation. Let's work towards getting you ready to be ready for property selection. That usually is a 2 or 3 phone call process right off the bat. And then once we're ready for property selection, you're going to be treated just like our other clients who have buying plans that they're proceeding with and filling. And when an opportunity like this comes up, you're going to be presented with this just like another client who is coming back and buying their 10th home.
That makes sense. Let's knock out a couple more of these questions. So Mej Garcia asks, welcome back, Mej. I haven't seen you in a little while. What does this mean? JWB will cover the cost of the first property turn. I'm not sure what she means by this. Mej, why don't you put that in the chat and we'll come back to this question. Does that make sense? Kiran Lanka, I think that's a new name that we're seeing here. Welcome, Kiran. So Kiran Lanka asks, do you have a list of the neighborhoods where you are developing properties?
Yeah, we're always in the same neighborhoods over and over and over again. So I'll give you some zip codes right now, just because a lot of folks really love that zip code list. So we've got the north side of Jacksonville. The zip codes there are 32208, 32218. We've got the west side of Jacksonville, 32210, 32244, 32205. We've got the south side, 32207, and then we've got Arlington, 32211.
All right, I'm putting that in the chat for everybody that wants to see it. 322. So I'm just putting 322 and then the last 2 digits for anybody that wants to see that. And Kieran, I recommend that you look back in our archives. We actually did a whole episode. You can find it on the podcast. You can find it in the YouTube channel, or go to Not Your Average Investor Show. But we did a whole podcast on the different neighborhoods that people invest, that JWB invests in, and we show the population, right? Like the dots on the map, and it's just this like massive like blob per neighborhood where JWB totally dominates, which I think is pretty cool. So Lorente McCrary asks, where do you get tenants from?
Great question. I mean, nothing in this model works without being really good at attracting high quality residents, and high quality residents that want to stay with you for multiple years is the key. So that means that our standards for getting a resident are much higher than anywhere else, because if somebody comes and wants to rent for a 1-year lease, generally they're going to be told, I'm sorry, that just doesn't work for us. We only sign 2 and 3-year leases. And so that makes it much harder. So you have to be very good at finding residents. I'll tell you, so I run our marketing on both our turnkey side as well as our rental home side, driving in leads. You guys would be shocked to hear how many leads we have to drive in to be able to rent out, 1,200 homes, 1,500 homes next year. I just put the business plan together. We're going to drive in over 61,000 leads of new residents that want to rent our homes in 2021 to hit our goals. We will have driven in over 53,000 leads in 2020 to hit our goals. So the amount of leads that come in to be able to make this thing work is mind boggling. But I'll tell you, it's not like this, it's this unknown way of doing it. We just do it at this massive scale, right? We're really effective with our online advertising, right? We syndicate to all the major websites, your Zillow, your HotPads, your Trulia. We have a big presence on Facebook. Do a lot of Facebook advertising to drive our residents our way. Our website is set up in a way that it makes it easy for people to schedule online showings. And then we do outdoor signage. So we put signs up. So none of that is rocket science. The secret sauce is the execution and doing it at scale, which is really how we're able to do that. And we have to be able to do it at scale. We have to drive in 50,000 plus leads a year, 60,000 plus, because if we didn't, we couldn't be so choosy and we couldn't require long-term lease. And then, the value wouldn't be there for you as a rental property investor.
There you go. And listen, as a marketer myself, who sees, I work on the side of the turnkey rental income property piece, and I don't work on the side of the marketing that goes towards bringing in new tenants. I am super, super impressed with the machine that you guys have built out. Like it is a highly sophisticated, like you say, it's not rocket science, but to me, it's very clearly a highly sophisticated B2C consumer funnel that is very, very effective at creating awareness and then filtering through the to the perfect client, essentially, is how you think about it in marketing terms. So, I don't want you to take, I guess I want to give you credit and the rest of the team credit where it's due, right? Like it is a pretty impressive machine that you have been working on for years that I've gotten to like talk to the people that have built it. So I think it's really cool.
It's incredibly important and a huge credit to the team that puts it together. Pablo knows Kate on our team very well. Kate really is the mastermind behind that whole entire process. At the core of it, if we don't do that well, nothing else works. And so huge credit to our teammates.
Yeah, right on. So we got a couple questions here. So Ray and I have been going back and forth here in the private chat. He said to talk to me about 32277. Is that one of that is where he owns a property that's north of Merrill off Cessary in North Arlington?
Yeah, it's in Arlington. 32277 is a great area. And the only reason I didn't say that one right off the bat is because with prices doing what they're doing and inventory levels being what they are, it is incredibly difficult to find a cash flowing rental property in 32277. I don't know the last time that we had one available for clients. And it's because it's just really hard to do that, especially for existing inventory. Maybe for new construction, we can still get there every once in a while, but it's really tough. If you had gone back, 5-8 years ago, 32277 was much more in play for us. So we do love that neighborhood there. It's in North Arlington. And, a lot of the same characteristics that we love about the parts of Arlington we're in right now play very well there. So I think you have a great investment right there, Ray. It's just going to be harder and harder for you to find those going forward with prices doing what they're doing.
Does that count as one of these like under promise, over deliver, when now all of a sudden Ray owns a home in a neighborhood that is no longer at that same exact kind of like valuation where the price of the home is higher than the rent itself?
Well, and I don't know if Ray bought that home from us specifically. I think he may own that, may have done that prior. Ray, feel free to chime in there. I just don't want to take credit for that if that wasn't the case. But I mean, the point is that we have sold properties to clients in 32277 over the years. Those have appreciated to a point where we can no longer, by and large, go there and find cash flowing assets. So they're definitely benefiting from that, which is that profit center that we talked about right off the bat. It's why home price appreciation should be factored in if you're a buy and hold investor.
All right, sweet. So Medj Garcia clarified. She says that the recent property that she purchased has a comment like JWB acquiring with Heritage and would cover the first property turn. And that is what she's saying. What does this mean? JWB will cover the first property turn. I think she's talking about us teasing that this has a some abnormal quality. So let's go back to that. Do you want to talk about those heritage kind of properties?
Yeah, absolutely. And she's right on this one. We haven't even gotten to that part yet. And I don't even know if I shared that with you when we were prepping for the show. But so this actually is the same type of arrangement, Pablo, as your rental property, right? Do you want to tell people about what we do for you and the property that you just put under contract?
Yeah, it's what Mitch just said. So in the property that I put under contract, the tenant was already there. So JWB sent out somebody to look at, and I believe it's MJ, right? That goes out there and checks it out. MJ, who does this all day long, went out there, looked at the property, decided that the tenant improvement cost in between turns would be, I believe, $6,500. So JWB has credited me on the next turn. Whenever that tenant improvement cost needs to happen, I have a credit of $6,500 to apply to that, so that it doesn't come out of pocket, because that would have been a cost that JWB would have incurred had they brought in a new tenant. Is that kind of right?
You nailed it, brother. And you were just telling me that you felt like you didn't know all of the specifics on your investment. Bro, you just killed the game there. Way to go. And that's exactly. So that's an example, right? You know, JWB, we've been doing this for 15 years. We have the things that work to make sure that you're going to be successful. But we're always looking to make the best decision for you in a one-off scenario. That's what we did with Pablo's house, because now there's a resident in place for Pablo, who's a great resident, cash flow positive from day one. And it wouldn't have made sense to go in there just because we bought that property and then remove that resident or disrupt that resident and do that $6,500 worth of work right now. Doesn't make sense to do that. Nobody wins there. So we said, let's keep that resident in place, hopefully keep them there forever, right? Pablo buys the house from JWB, and that $6,500 that we would have spent, now JWB is still going to incur that cost, and it's going to benefit Pablo more later on. And so, and that's what's happening here on the house on Mel Street. The same exact thing is happening, right? This is not, I won't say this is normal. It just happens to be the one that Pablo bought, and it happens to be the one on Mel Street. You know, it's not normal. But when there's an opportunity that it makes sense for all parties, that's what we're going to do. And so the client who purchased this one has a similar credit coming to them on the first turn that Pablo's experiencing.
Interesting. So why don't we just take this opportunity to go into the other extraordinary situation here, Gregg? What was that again?
Yeah. So this one has a 1-year lease in place. 1-year lease, right? Gregg, you talk about 2-year leases all the time. What do you mean it has a 1-year lease, right? Well, this really was like a perfect storm. And one, at the end of the day, when we run the numbers, we looked at it and we said, are we doing the best thing for our client and for the returns if we would accept a 1-year lease here? And that's what we decided. So as I shared with you, $1,100 of rent versus $1,025, that's huge, right? That's $750 a month. That's what, $1,000 a year right there.
I mean, it's an extra 1.75% return on the sheet, right?
There you go. Right. That's a huge motivating factor. Part of the other reason why we don't do 1-year leases is because, well, the part of the reason we don't typically do Section 8 leases is because there's a lot of additional like costs and holding time for you until you can get your rent. Usually there's about 60 days worth of inspections that go into it. And we don't want to go to you and say, hey, we've got a great resident, but you have to wait 60 days to get to positive cash flow. No, in this case, the client just put this home under contract. This was just rented. So those are going to line up perfectly by the time that the client is ready to close on the home. It's going to be cash flow positive. So they're not stuck holding the bag there. And then the other thing is that I do like Section 8 properties. What we have found is that in certain segments, they have cut the voucher amounts. And so in this case, because we have a voucher that's so much higher, there is nothing wrong with Section 8. The only problem with Section 8 is that they don't allow you to sign 2-year leases. They limit you to only signing 1-year leases. And so, you know, with our ability to re-sign residents, we have a very high re-sign rate overall, and especially with Section 8. We looked at this and we said, the best thing for this client is for us to go a little bit outside the box and then to accept a 1-year lease for a Section 8 resident that is $75 a month more. Really a no-brainer, and this client's going to benefit from it.
So, all right, if I'm deconstructing this right now, the perfect storm is this is a Section 8 housing that's already occupied, or the timing makes it so that it will be occupied day one of closing on the house. The Section 8 actually raises the price of rent versus what you could have gotten on the open market without Section 8. And this is one of these heritage homes that somebody was already in and you are crediting whatever you would have incurred on the front end, right? Like that seems like three things that had to coincide to create this to happen. And then there's the idea that you always, you preach this a lot, right? Like you're a hedgehog, right? Like JWB likes to stay in their lane because they know what they're comfortable in. They know, what works. What is the difference here? Like what is the main key differentiator in your decision-making process of hedgehog versus not hedgehog here?
Well, this is right in line with the hedgehog. I wouldn't say this is a deviation from the hedgehog, right? This is us just making the best risk adjusted return for the client to set them up for success, right? I mean, we have about 10% of our portfolio, I think maybe a little bit less now, maybe 7-8% of our portfolio is rented through Section 8. So it's something we're very familiar with. And over time, we have made decision to do Section 8 for certain properties. Generally, it's when we see that voucher amounts are either at market rent or above market rent is when we're going to be okay with Section 8. And so many clients have 1-year leases for a Section 8 home. I mean, geez, we manage 3,600 properties, right? So 360 clients potentially have Section 8 leases, of which many are mine. I have Section 8 leases. But there just has to be a reason why it makes sense, So like out of the hierarchy of things that you just described there, the most important thing is the voucher amount. Like for example, 5-bedroom homes we know generally see higher voucher amounts from HUD. It may even be above market rent. And so we look at that and we say, well, what's the benefit of doing that versus potentially seeing an additional month lost of rent while you go through the inspection process? And we run that analysis. Sometimes it's not a full 60 days that you have to deal with HUD to get through the inspection. Sometimes they've got their stuff together and it's 20 days, right? Then you might see us go more to Section 8, right? We think the Section 8 program works and we're willing to do a 1-year lease if there's an additional benefit. And for all of you who might not be familiar with Section 8, at the end of the day, the government pays all or a portion of the rent, right? So that is a big bonus as well. So, while we preach 2- and 3-year leases, you're going to hear me sing that from the mountaintops forever. We also are going to look and say, in very specific instances, what can we do to do the best by you? What can we do to do the best by your returns? And if that means taking a Section 8 resident and signing a 1-year lease, we're going to do that. We're going to talk to you about it. We're going to explain why this is going to benefit you. And then, we're going to do it for you.
I like it. So then at the end of the day, this is what I like about everything that kind of, on a personal level, you kind of stand for and what JWB stands for. And it's the idea that you're here to serve, right? Like you are, even though this is what you normally do, you're not gonna take an option off the table as long as it is in the benefit of your investor, of your client, of your, like the people that you're serving, which I think is really cool.
Real estate is not the stock market, right? Real estate is somewhat messy behind the scenes, right? We're taking families, having them rent a home, and then having other families own that home, right? There's a whole lot of family stuff and housing stuff and all this good stuff, right? It's a somewhat messy thing that we try to make sure isn't messy for you. But in that mess, there can be great things, right? You need a team who understands, has the experience, who can navigate this. Because it's not all simple. I mean, there's going to be challenges, Pablo. There's going to be challenges that you face with your rental property portfolio. But what you're going to see from our team is that most of the time it's going to go swimmingly. And when it doesn't, you're going to see us come to you with a solution and say, here's the best thing to do that we would recommend. And then here's why in the long run, this is going to play out. And then as long as you're prepared to handle some ups and some downs in rental properties, which happen, you're going to be fine in the long run.
Sounds great, man. Listen, we are 2 minutes over our hour mark. How tight on you on time? We got 3 more questions. Can we hit them?
Let's do it.
All right. We got 31 people still with us. So we're here. We are here to serve. Carol Moaning, who, by the way, welcome back, Carol. Another name that I'm recognizing, a repeat Not Your Average Investor Show attendee. Once the lease is up, how much do you charge for the marketing to find new renters?
I love that question, Carol. You're setting me up. How much do we charge for marketing? 0. All of this lead engine, the systems that take to drive in 61,000 plus leads in 2021, we're not charging you anything for that, right? Most property management companies charge these little ticky-tack fees to market. They have a marketing fee or an account setup fee. We don't charge anything there. We charge a lease renewal fee, which is our relationship with that resident over years to get them excited to renew with you. And that's relatively inexpensive. So that charge is $200 for each year that we renew for your resident. So if we renew them for a 1-year lease, it's $200. If we renew them for 3 years, it's a $600 charge. But we want that cost to be really low for you because that's going to ultimately increase your return on investment long term.
There you go. Great answer. Great question. Anonymous attendee. I think you're a new a return anonymous attendee. Do you guys finance in-house or third party? Do you work in 32209?
Yeah, I'll take the last one first. That we do work in 32209 in certain sections of that zip code. We do have a lot of properties. I love it. It's very similar to 32208 in certain zip codes. In fact, Pablo, your property might be in 32209 or maybe 32219. I don't know, or 32208. It's close.
Yeah.
So certain section of 32209 we do invest in. And do we have financing in-house? We do not. Part of this, we want to be an arm's length transaction. So there's comfort in knowing that there is a financial institution, a bank that is going to originate your loan for you. It does not come from the bank of JWB. There is no bank of JWB. What we're going to do is we're going to set you up and facilitate that relationship with your approved lender in our network. And we're going to quarterback the whole situation to make sure you can show up at closing.
And the way I understand it is you guys work specifically with a certain set of lenders, not because you have some kind of back end deal, but because you know that those lenders understand this transaction well, and there is no surprises as far as getting the deal closed, right?
Exactly. Sometimes folks ask us if we get a referral fee by referring you to a lender of within the JWB network. We do not. We have never received any referral fees for doing that. Our intentions are to make sure that you have the best loan and to make sure that that loan closes. And we do require that you work with a lender within our network because flat out, there's just way too many lenders out there that promise the world that can't deliver. And we need to make sure that we can show up and make sure that you can get to the closing table to serve you and to help you build your portfolio. So we do not get any incentives there.
All right. Last question. Denny Davies asks, Gregg, what are the latest average turn costs over the past 6 months or whatever time frame you're tracking? Thanks.
Denny, long-term client. Denny, good to hear from you. So thanks for being on the show, my friend. Long-term, generally, I haven't pulled the numbers over the last 6 months. I'm not prepared for that, but it's about $3,000 as an average turn cost. And what that nets out to a client is about a $2,000 out-of-pocket expense. All right. So a $3,000 turn cost would be what, Pablo, we'll just keep it real personal for you, right? For when you have your first property turn, on average, the scope of work that you'll see from our team would be $3,000. Now, the net cost to you would actually be somewhere around $2,000. Why do you think that would be?
I don't know. I knew you were going to ask me that question. I've been formulating, but I'm going to need your help here, buddy.
I love that you don't know everything, right? I love that you don't know everything. It's why this dynamic works so well. Security deposit that we collected on your behalf from your resident up front. So if there's $3,000 worth of costs, the overwhelming majority of the time, we're going to be able to hold back that security deposit, or at least a large portion of it, that's going to go to offset that $3,000 cost for you. So the net cost to investors that I would share with everybody to be prepared for is that'll be about $2,000 out of pocket. That's what we've done sort of, over the last few years and lifetime. Those are the numbers that we've seen, and I'm sure it's pretty accurate for the last 6 months as well.
Interesting. So I learned two things here. One is that you have the security deposit that you get to play with and lowers the net thing. And the other thing is that you like me for my looks, not my brains.
I wouldn't go that far.
All right, just checking. Gregg, so what entails the average property turn? Is a little bit of paint here, a toilet seat there, kind of what is that $3,000?
Most of the time it's the general items, right? It's the paint, it's fixing some flooring. Now I'll tell you, you have a hard surface on your floors. And the majority of our clients do, especially the ones that have purchased over the last few years, have hard surfaces on their floors. That's a great way to reduce cost during a turn, right? Other investors out there still put carpet there because it's cheaper to put it off the bat. But if you have a turn happen and you have somebody that spills something on one piece of the carpet, you have to pull up the whole carpet to fix it. But to get back to your original question, maybe there's a piece of vinyl plank flooring that has one issue with it. We can just pop that board out, replace that. Maybe that costs $75 or $100 rather than replacing carpet of $1,200. But it's really kind of like death by a thousand cuts rather than, a cost of a roof or an AC unit or things like that. It's just the little things that add up. You got to make sure that this home pops when somebody goes to rent it so that we can get the home rented very quickly for you. And so we're going to do the little things that need to be done to make sure that it rents quickly.
Cool. Carol Millening asks, so you hold the security deposits for us?
Yes, Carol, we do hold the security deposits for you.
Perfect. And then Medj has one final question here in the chat. Do we get incentives for giving you referrals to buy turnkey properties?
We do, but there's a caveat with it. Anybody who makes money on real estate has to have a real estate license. That is a rule. And so we love referrals. That's how our business has been built. Over half of our business comes from referrals. So Medj, thank you for thinking of that. And we would love to speak with anybody that you would like to put us in contact with. If you are a licensed real estate agent, then we would love to pay you as well for doing that. We pay $1,500 referral fees or commissions on the HUD for any property that is purchased by one of your referrals for life. So if that client comes and purchases multiple properties, like I know Medj is doing, Medj, congratulations. I think you just put another one under contract, so congratulations. For any of your friends or family members that would do the same every single time, we pay you $1,500, and we do that to any licensed agent out there.
You know what I think, Gregg? I think we need to have Medj on the show. What do you think about that?
Let's do it.
Yeah. All right, Medj, if you're into being on the show, reach out or put it in the chat. We'll reach out to you. If you just got a new property, you can tell us your story. Would love to talk to Medj. That's it for today, Gregg. We have still 28 people. It's been an hour and 10 minutes. This has been awesome. I am always humbled by the idea that you and I can have one of these conversations and we can be joined by 20 old friends and 50 new friends that spend a little bit. Okay, Medj, not ready yet. That's cool. That spend an hour with us in the middle of their weekday. So thank you everybody for being here. Tuesday, right? Upcoming show. We are talking about, Gregg, do you want to say it or should I say it?
Yeah, we're going to break down really the truth behind why you have probably heard your accountant and other people say you got to buy rental properties before the end of the year. You got to buy them before the end of the year. What I have found is that everybody says that, but nobody really knows why. So we're going to break down exactly why and what the benefits are of buying properties and closing on December 31st of this year versus closing on January 1st of next year. We're going to do a deep dive and set you guys up for that.
Awesome. I'm looking forward to that because I have heard that multiple times, and I am looking forward to getting educated on just why that is. So I think it's going to be a great show. We were kind of hashing it out a little bit. I'm pretty pumped about it. Apart from that, again, if you want to download the property sheet that we just had, go to jwbwebclass.com, sit down with Gregg for a couple minutes, get learned on the basics of rental property investing and get the free investor toolkit. If you want a personalized response to anything that we're talking about, like the question about insurance or the rates or what townhomes we have available or whatever, go to chatwithjwb.com. And outside from that, Gregg, I just want to thank you for this time we spent together and leave it up to you, buddy.
I appreciate you. Appreciate everybody being here. It's always an honor and a blessing. And I'm just excited about this weekend and of course the show next week. There's a little something happening this weekend in Florida Gatorland on Saturday, though, brother. Hey, are we gonna pull it out this week?
I as a Gator fan, I just never tend to fear Georgia. I don't know what it is. I just don't fear them.
I know. They've beat us like a bad habit the last few years, but I know what you're talking about, right?
It's been so long. Yeah.
Hopefully, and go Gators. Let's bring home a big victory this weekend and put an extra big smile on Pablo and my face on Tuesday. We will see you guys later. Thank you guys so much.